All right, I'm Jarod Winters. Dan asked me to come to join you guys today and bring a little bit of the institutional perspective to the topics that we're discussing today. I'll get around to kind of the thrust of what I'm after, and that is to say that individuals have significant advantages when it comes to trading the markets that the perceived institutions actually, you think the institutions have them, but I want to tell you the individuals really have it all over the institutions in certain ways. So the reason I come up with this perspective is a little bit of my background. I started off early in my career as a day trader, not to age myself too much, but this was before stocks were trading in decimals. They were trading in fractions, and if you wanted to trade electronically, you had to call out your order to an order inputter who had to put in a certain NASDAQ protocol, and those were the days. Now, of course, everything is electronic. And so it led to actually creating software for day trading. Now, this is an area where, still today, the individuals were leading the innovation league. The institutions did not have the tools, and quite honestly, fundamentally, they kept a lot of the tools out because it was new. Okay, so this was a perspective that we had probably going on 20 years ago now. So with that, I moved to New York City, and in New York, of course, is where everything happens sometimes. The background that I brought to it was really from the operations side. I wasn't a trader at that point. I tried my hand at trading and making sort of discretionary decisions based on price action. That wasn't for me. But I certainly love the industry, had passion for capital markets, and being able to supply the tools for traders was something that I was passionate about. So working on the operations side, I worked at a service provider to Merrill Lynch Prime Brokerage, and you may hear the word Prime Brokerage, and I think Prime is, a sort of a fancy name. It really means the one broker that holds all of the stuff, okay? Because institutions, unlike individuals, they trade with lots and lots of brokers on the street. It took me a long time to understand why that happens, and I don't want to cover that today, but the point is that there's a special type of brokerage out there that supplies brokerage services to institutions, hedge funds, and the like, and that's my world. And that's sort of how I came up. Now, after a number of years of that and doing consulting to hedge funds, and the nature of the consulting was operational. It was making sure that the trade desk and the operations desk and the portfolio managers, everything was in sync, and there weren't trade breaks and all sorts of complications that individuals don't normally have to, worry about. And then a number of years passed, and I was at Wells Fargo Prime. And really the big takeaway there is the tool set that we worked with were really geared toward institutions giving you all sorts of reporting to your investors. Okay, that's something that you don't know about because you don't have investors in you necessarily as an individual. But I want to tell you about the complications of that, and I'll cover that in a little bit. So my background is with hedge funds. Hedge funds are a very misunderstood thing unless you've been inside the industry. Hedge funds can be big institutions. They can be, a portfolio manager with an investment committee, and there can be, all sorts of mandates from their institutional investment partners, or it can be, a trade ideas terminal and an order entry terminal. That's what a hedge fund can be, all the way from one end of the spectrum to the other. But they all have really the same needs, and that is there's trading, there's reporting, and then there's quality workflow. And so that's sort of always been my perspective in working with funds and being able to market themselves to their investor base. So 14 years in New York. In my life, I did a big change, and I made a move from working on the sell side to the buy side. Now, what's that? I mean, I was selling my services, my reporting tools, my aggregation tools to the traders of the world. And then in coming to San Diego and moving, I got to become my very own client. I'm now on the buy side. I work for a hedge fund. I'm the chief operation officer at Sunrise Capital, and I'll talk about that in a minute. And are my things falling off the bottom there? Okay. What I have there on the bottom is talking about sort of my licenses. I was a broker. I had a brokerage license, and I used it. It's probably sunset at this point since I've been on the buy side for a couple of years. But I also wear the hat of chief compliance officer. And compliance is a huge area of concern for the institutional side of the business, and it's been an education for me, and it's a major hat in any institution, and something that individuals don't necessarily have to worry about. So I'm going to come back to this in a second. This is about Sunrise Capital. But what I really want to talk about, and this is the big sort of overarching piece here, the difference between institutional and individual, the big things that you have to worry about. Number one, business economics. As an individual, like Jane was talking about, you can make additional income by trading discretionarily when you want to. If you're running a business, you've got business concerns, you've got overhead, you've got the light bill to pay. So we'll talk a little bit about the business economics. Regulations and compliance. Well, everyone's got regulations, but they're deeper and more onerous when you are managing other people's money. That's going to be another big one of my touch points here. The opportunity set. Maybe this is where I'll end up closing on the opportunity set, but it has to do with the trading opportunity set, right? What can an institution invest in or trade, and what can individuals invest in and trade? I really want to talk about the nature of other people's money versus your money. Okay, yeah, the competitive landscape, you'll get that along the way as well, but really, I think a lot of the crux of this is the nature of managing other people's money, and then of course, how that comes to you as an individual as an advantage. So to begin with, all right, the business economics. As an individual, you don't have to pay yourself. If you want to take the day off of work from trading, you don't have to. But if you have a hedge fund and you have people employed there, you got that overhead, okay? If you're running a fund, you have to have a chief compliance officer. Sorry, that may be you, and you may be the trader and the back office guy and the operations. You also have to be a compliance officer, okay? Or you got to hire one. Oh, and guess what else? If you have public funds, you have to have an auditor. Oh, and you have to have your prime brokers. Oh, and you have to have your compliance consultant. So you have overhead as a business that you wouldn't have as an individual, okay? And then, of course, what comes with that is people. Got to get good people. You have all the fun parts of human resources and managing people and the interactions therein, right? And then service providers. Choosing good service providers and demonstrating how good your service providers are to the people who invest in you. It's going to be another big touch point. But service providers are a big area of the business. You're paying them a lot of money, and they have to be good, right? And that's part of your business. Regulations is something that I'm going to spend another minute on down the road. But the regulations to an institution are they're more onerous because it's not your money, it's other people's money, it's investors' money, and that's a big takeaway there. And then, of course, the other part of it is complexity in the business. When you have multiple accounts, when you have multiple relationships on the street with brokers, the operational risk of delivering trades incorrectly, of potentially dealing with cybercrime and getting phished. Someone comes in and they can trick you into sending a wire to the wrong place. These are business-ending, events. So that's a disadvantage to being in business, is that business can end. So, talking about the regulations and compliance, I mentioned that I'm a CCO, right? That means I have to wear the hat when a regulator comes to visit me. I get to sit across the desk from them and do the whole interview. That's my job. My job is also to make sure that all the filings get done. You have to do quarterly filings with all the different products that you manage out there. And if you're an advisor, you have to report on yourself. Licensing, all your traders have to be appropriately licensed, and you have to have an advisor license. So a number of requirements in order to get into the business on the regulatory side. And if there's questions on that, I'm happy to talk about it. But the takeaway from that is it's something that as individuals you don't really have to worry about as much. Here's, I think, the big thrust of it. Dan and I occasionally have conversations about the type of trading that he sees on Holly and the type of trading that he'll demonstrate that Holly will find coming up in the market. And the big piece that I have a hard time wrapping my head around is how does an institution take advantage of these ideas? You heard Jane talking about how she loves to play low float stocks. I think that's great. I'm going to skip to another slide here for a second, but I want to talk about this for a second. Let's say you're a typical trader, right? you're going to have certain objectives when you're trading for yourself or when you're trading for an institution. I thought this was going to animate. I wanted to show you the top block first. So let's say you have one strategy, right? You have one strategy or a couple of strategies, and this is what you're going to implement on your asset base. So if there's 20 trading days in a month, and your style is to make roughly 4 trades a day, 80 trades a month. Okay, let's say you can count on 60 to 40 losers, winners to losers. Just throwing out some assumptions. Go ahead. I'm sure some of you guys are way better than 60-40, but I'm just going to put that out there. I modeled in an assumption of a 50-cent winner. I also, assumed a half the size of that as a loser. And I want to just demonstrate, if you're looking as, I guess I don't have a pointer here, but if you're looking as an individual, right? Jane was talking about the additional income she can make, by either targeting a certain amount per day or per month. What I'm trying to model out here is if you're an individual and you're trading an account, let's say you're an individual professional, this is what you do as a living, and you're using an asset base of $250,000, in order to make a living, you got to make a 50% return on that, right? Just throwing a number out there. So what does that come out to? That's a monthly target of a little over $10,000 a month. That's 50% growth, but we all know that that's potentially attainable. The size of a trade to make that happen would be roughly 650 shares. You can do that in a low float stock. If you're trying to make a much more modest return, say 15% a year, which is still impressive, don't get me wrong, it's impressive, especially at an institutional scale. But you're managing an asset base of $250 million, which may sound like a mountain, as a individual trader, but it's not when you're an institution. There's institutions out there trading hundreds of millions of dollars and billions of dollars every day. If you want to make a return of 15%, your monthly target's a little over $3 million. You can't really play a low float stock on 200,000 shares. You couldn't do that. That opportunity set doesn't exist for the institution. So I wanted to kind of give you that idea to think about here for a second. So that's one side of it. There's just not as many trades that you can get into because there are niche trades that things like Holly will bring up that an institution couldn't take advantage of. Excuse me. Let me take a step back. There's another part of it, and this really kind of gets to the nature of other people's money versus your money. When you are taking on other people's money, what have you done? You have presented to them a prospectus. Say, I'm an investor, I'm a trader, I'm a professional. Here's my background, here's my strategy. And you're going to lay out your strategy. You're going to publish the description of your strategy. Oh, and by the way, you're going to file it with the regulators. Okay? You're going to disclose all of the risks of your trading style, of the instruments that you're trading in, and it's going to get into risks that you're like, come on, these are obvious. Do I actually have to put this in my disclosure document? Yes. Everything has to be disclosed, these potential risks. And then, very importantly, there's the reporting and the metrics. Not only do you have to say what you're going to do, you have to do it, and then you have to tell everyone the details of what you did. And you have to, characterize the nature of it, right? Did you trade the way you said you were going to trade? Did you invest in the sectors you said you were going into? Did you employ the strategy you said you were going to employ? If you're trading a long-term trend-following strategy and suddenly you start day trading some low-float stocks, your investors will be interested in your style drift. That's a bad word in the institutional space, style drift. You don't want to be accused of that. So it's a very big piece regarding the reporting, the metrics. Let's see. We talked about the limited by scale. And then the visibility, there's another piece to it, and that's also fiduciary nature. When you take on someone else's assets, you're their fiduciary, which means that you have to put their concerns in front of yours. You have to look out for their money better than if it were your money, okay? And anyway, these are a couple of the big pieces I wanted to highlight. So, advantages to the individuals. Size. Believe it or not, being smaller gives you an advantage, right? You get a broader opportunity set than someone in an institution who's trading a larger asset base. I think I boiled it down to a friend of mine the other day. I said, you know what, if you're in the open ocean, sometimes it's better to be on a Sea-Doo than on an ocean liner. You're way more nimble, right? You don't have maybe the same creature comforts as you would, but you can get out of trouble a whole lot faster. Or you can take advantage of I don't know, jumping awake or moving out of the way a whole lot faster. So that's the way I like to think of it. The other, you don't have to put a trade on. If you don't like what the market's doing that day, if the theme of what's going on doesn't make sense to you, you don't have to trade it. You want to know why? Because no one is paying you to take risk. If I've taken someone's money and I'm managing it for them, they're paying me a certain amount of money to do that. And if I'm sitting on the sidelines, before too long, they're going to say, and why am I paying you to manage my money and you're doing nothing with it? I can do that very well on my own, thank you very much. So in being an individual, you don't have investors calling you. That's nice. You've limited your operational complexity. A lot fewer things can go wrong. The liability that can potentially befall you is a whole lot lower. And I think the other thing about it is that, and without to be too obvious of a lead for trade ideas here, I think the ability to collaborate with your trading community is something that really institutions can't take advantage of because of the appearance of it, right? The appearance of potential collusion or market-moving activities. Trust me, market governors are looking out for market-moving activities. You're not going to move it with your 650 share trade, right? And there's certainly, as Greg described, there's a whole lot of institutional, infrastructure, especially in the research industry, that gets, that kind of gets at the difference between institutional versus individual, and the ability for institutions to get in earlier into a trade, and the information set coming out there. But not to be fooled, which is what Greg was talking about. But here you have not only the ability to collaborate, you also have these tools and the ability to take advantage of trading decisions and pivot, make that quick right turn on your Sea-Doo, rather than have your whole investment committee, the size of the seaborne ocean liner, consider a trading idea or an investment idea, and have to go through the grind of an investment committee. So these are a number of the things that I guess I wanted to talk through, and I'll leave it kind of on this scale slide right here. I feel like I went fast talking over the nature of institutions and maybe sort of where I came from. So if anyone has questions about hedge funds, Brad.
You mentioned nimbleness, and you kind of alluded to a jet ski versus an ocean liner. Tell me a little bit about kind of the restrictions that an institution may be under with respect to the time horizon of holding a position.
Great. So, okay, Brad's question really was the opportunity set as far as size, but also his question was now the question as far as time horizon, the ability to hold it. Right, so you're talking about, are you looking at things in terms of minutes, hours, days, weeks, months, years? Yeah, got it. It kind of goes back to the published strategy that you sold to your investor, right? If you came into my shoe store and you said, I need a pair of running shoes, I said, no problem, I got a pair for you. Give me your money. I took your money and I came back and I brought you a pair of dress shoes, we'd have a problem, right? If I tell you as an investor, I take a long-term value-seeking approach and blah, 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 and all of a sudden you come to find out that I'm actually making day trades, whether or not it's profitable or not, right? We got a problem. As an institution who has fiduciary responsibility, I got some splaining to do because I've taken on a different risk profile than that which I sold you, right? So it kind of goes back to that. So can you have a day trading strategy as an institution? You absolutely can. You can, gosh, you hear about the flash crash and all the guys who are trading quant, right? You have monster quant shops out there they're not only quant on their analysis side, they're quant on their order execution side. And they're out there and they're trading, in nanosecond, increments, right? You almost can't get faster physically than the way they trade. And they're hedge funds. They're taking in institutional money from really savvy investors and they're trading a quant strategy that has these little itty bitty time horizons. So the answer is you can do anything. It's got to be disclosed, and it's got to be reportable, and you got to actually do it, and you got to report it, after the fact.
The tax implications typically prevent the institution from taking a shorter term, or not?
No. So that kind of gets to a really big polemic of whether it's trading or investing, right? And whether something's long-term or short-term. And now, of course, there's ETFs. They have different long-term, short-term treatment anyway, whether you're holding it for a year or less anyhow. Or at least the options do. They have the 60-40 long-term, short-term rule on it. Look, because of the nature of an investment in a hedge fund, most investors get to treat their gains in it as capital gains anyway. It's not 1099 trading income anyway. So to those institutional investors, they don't think of it that way, right? If you're the hedge fund, sure, it gets taxed the first time through whether it's a long-term or short-term trade, right? But hey, on a winning trade, giving up 35% isn't too terrible, right? So no, yeah, you can trade on either. Go ahead.
How much of your own personal investing do you do, and how do you kind of separate those two sides?
So I mentioned that my entree into the capital markets was as a day trader. I was terrible at it. I'm way too emotional. On the few winning trades that I had, boy, was I smart. And anytime I made a bad trade, and God forbid if I made a bad trade on a Friday, because I cursed Saturday and Sunday. I wasn't cut out for it. I have done mostly passive investing, except for a couple of targeted investments in private entities. That's me personally. Yes?
What strategy, if you can share, maybe a big picture Sunrise Capital does? And then another question, choosing, since you have to, as a hedge fund, disclose that strategy, in general, do the hedge fund then choose the tools, like informational, analytical tools, based on that strategy, or in the industry of the hedge fund, some of them choose other tools, and how is that correlation between the actual strategy that they disclose and what tools, informational arbitrage, they use to kind of...
Thank you. I'm glad you asked that question because it kind of brought me back to a slide that I skipped over. So the question was, first of all, about Sunrise. What is the nature of our strategy? In our case, there's multiple strategies. And then also, how do the strategies inform the tools and vice versa, right? So in the case of Sunrise, and maybe relevant to us here today, we're a quantitative firm, and really unusual in the quant firm. We're an old quant firm, almost 40 years old, and it's almost like a Michael Dell story. One of the original founders, Rick Slaughter, who's still there today, basically was doing a long-term trend-following model in his dorm room here in San Diego, by the way. So he really was one of the pioneers in the space. Now, in his case, we've always traded futures. Very little stock trading at Sunrise. There's a little bit of ETFs we could talk about, but it is definitely a quant strategy. Now, what sort of well, let me hit that other point. It's trend following. In this case, it also has to do with the time horizon. There's long-term trends and there's short-term trends. I don't know, I guess if it's too short, you don't call it a trend, right? But it was a trend following strategy, in commodities, and for a lot of those years through the 80s and 90s, when commodities were actually trending for periods of time, amazing amount of wealth was able to be made because of rolling your futures positions forward every 3 months. So to pivot to your question about the technology, the data set that Rick Slaughter implements hasn't changed over the years. I'm probably giving things up, but it's price data. It's price data. A lot of the social metrics and foot traffic data and stuff like that, that's excellent when you're talking about stocks and equity coverage. If you're trying to trade the S&P 500, you're trying to trade, copper, or you're trying to trade something a little bit more global and macro in that nature, it's price and volume data is really where everything is at. So it comes down to your techniques. Are your techniques short-term in nature? Are they long-term in nature? The data, the toolkits, the toolkits certainly have evolved over the years, without a doubt. And I have heard Rick say to me, actually, that sometimes when you get a new tool and it does more stuff, you actually end up doing more stuff. Imagine that. So, so the tools have evolved over the years, and even at Sunrise, we start to use newer tools. We are not currently a user of trade ideas. We like the trade ideas. First of all, we like the trade ideas management, and we think that the ideas that they bring forward in terms of the industry at large and sort of pushing the technology, into the institutional space, we think that's great, and we're fully behind that. And there may come a time when we start to, bring some more of the tools into the operational sphere of Sunrise. But we're fans of it. It's not something that we use internally, but we're advocates.
You use random walk or similar analytical reporting company that provides you with the valuable information in order to navigate through the strategy?
So our strategy doesn't trade stocks, and also the strategies are really based on very, very long-term price action, okay? They're really meant to look at 20-year moves. When Rick is done with a strategy, he's back-tested it 20 years, right? And then there are little, non-correlating strategies that we use in between, because if you look inside any 20-year period, there are some ugly periods, of course, and you try and trade against that, for the non-correlation. But anyway, thank you. Dan.
So Jarod, what you had brought up about the fact that the challenge for the institutional space is the lack of the ability to take that opportunity. In the futures market, like for example, do you have to pre-specify to your customers like the instruments you're going to trade? And the reason I'm bringing this up is because you can imagine that a hedge fund that's focused on some sort of technology, let's say, right? But all of a sudden a biotech starts moving, and it's the fear of the FOMO, fear of missing out and all of that out. It seems like that's a big hindrance to performance, to capturing alpha. How do you guys, how do you even tackle that problem if you have to, like, quote unquote, ask permission to capture alpha as alpha presents itself?
All right, so Dan's question was, if you have sold to your investors a strategy that, as described, would not be taking advantage in special opportunities in a stock, so there's a buyout or there's a news release, something like that. So for example, I have a fund. It can take investors that are qualified investors, and the description of it is, we trade futures, we may trade ETFs, we may trade options, we may even trade stocks, although it's according to this mandate to be following, long-term trends. If there was all of a sudden a hot, biomed, stock that came out and it popped, there would be some explaining to do, even if we made money on it, believe it or not. Investors want to know what their, not only where their P&L is coming from, they want to know what their exposure is to. Okay, if you've got a big institution and they're a teacher's pension, for example, they're not going to be out there necessarily buying the biomed stocks themselves. They're going to make investments into managers who are going to then, subdivide those assets and trade them, accordingly. If you've gone out there and said, hey, I'm a special situations guy, I'm going to sit on the sidelines until something gets my antenna up and says, hey, here's an opportunity to pounce for a short period of time, you can put that out there. But for someone like Sunrise, where they have published and put out there what their mandate will be, you couldn't do it. You'd get in trouble.
So it seems like the notion of the mandate is really a critical differentiator for the individual to be able to take advantage of anything is a kind of freedom that can be expounded on quite significantly.
Right, Dan. The notion of the mandate of the investor is exactly it. I mean, not to boil it down again, but if Brad came in here and said, hey, I'm in here to buy a pair of running shoes, and I go, great, and I take his money, and I give him a pair of shoes, but they're dress shoes. I've given him something for his feet, but it's not what he came in for. And that's okay. I mean, if it's me, if I wake up one morning and I go, I just need a pair of shoes, and I go in the closet and I get a pair of shoes, that's me. I only have to answer to me. It's my own feet. But if he's come in and I've sold him something, I've taken in his money, we've had an arm's length transaction, and I give him something that he didn't ask for, there's regulators out there who don't like that. Yeah. Oh, I'm over time. All right. So thank you all very much.
Thank you.